Question 926. Limited partnerships must include A. 4 limited partners for every one general partner, B. At least one general partner and one limited partner. C. A statement of purpose delivered to the Bureau of Real Estate, D. None of the above. Correct answer is B. At least one general partner and one limited partner. A limited partnership must include 1. At least one general partner. General partners have unlimited liability for the debts and obligations of the partnership. They also have full control over the management of the business. 2. At least one limited partner. Limited partners have limited liability, meaning their liability is generally limited to the amount of their investment in the partnership. They typically have limited involvement in the management of the business. Therefore, the core requirement for a limited partnership is the presence of both general and limited partners. Limited partnerships are the most common example of real estate syndicates, in which the syndicator sells interests in real estate to investors. Limited partners are passive investors. Question 927. The monthly net income of an investment property is $1,550. An investor is expecting a 13% rate of return. Using the capitalization appraisal approach, the value of the property is A. $135,748, B. $143,076, C. $176,455, D. $260,000. Correct answer is B. $143,076. 1. Calculate annual net income. Monthly net income, $1,550. Annual net income, $1,550 per month * 12 months per year equals $18,600. 2. Calculate property value. Capitalization rate, 13% or 0.13. Property value equals annual net income, capitalization rate, equals $18,600 divided by 0.13 equals $143,076. Therefore, the value of the property is $143,076. Key concepts. Capitalization rate. This represents the investor's required rate of return on their investment. In this case, the investor expects a 13% return on their investment in the property. Capitalization approach. This method of property valuation estimates the value of an income-producing property by dividing its net operating income by the capitalization rate. Disclaimer. This is a simplified calculation. In real-world scenarios, appraisers consider various factors such as market conditions, property condition, and risk assessments to determine a more accurate property value. Question 928. Which is not deducted from gross income when calculating net income to find a property's correct capitalization rate? A. Replacement cost. B. Property management costs. C. Interest on investment funds. D. Real estate taxes. Correct answer is C. Interest on investment funds. Net operating income, NOI, is calculated by subtracting all operating expenses from the property's potential gross income. Operating expenses include property taxes, property management costs, insurance, maintenance and repairs, utilities, if applicable. By deducting all operating expenses from gross income, you arrive at the net operating income, which is then used in the income capitalization approach to estimate the property's value. Interest on investment funds is not a direct operating expense of the property itself. It's a personal expense of the investor. When calculating net operating income, NOI, for a property, we only consider expenses directly related to the operation and maintenance of the property. Question 929. A contract may be considered unenforceable by a court for any of the following reasons, except A. Its contents cannot be proven. B. It is voidable by the other party. C. It was signed by one spouse rather than both. D. The statute of limitations has expired for a lawsuit to enforce the contract. Correct answer is C. It was signed by one spouse rather than both. If the terms of the contract are unclear or ambiguous, it may be difficult to enforce. If a contract was entered into under duress, fraud, or misrepresentation, it may be voidable by the other party. Legal actions to enforce contracts have time limits. If the deadline for filing a lawsuit has passed, the contract may become unenforceable. In community property states, property acquired during marriage is generally considered community property, meaning it's owned by both spouses. However, one spouse can often enter into contracts related to their separate property without the other spouse's signature. Question 930. Which of the following is required to create a valid contract? A. Offer and acceptance. B. Consideration. C. Mutual consent. D. All of the above. Correct answer is D. All of the above. A valid contract requires a clear and unambiguous offer from one party and unequivocal acceptance of that offer by the other party. Consideration is something of value exchanged for the promise. It can be money, goods, services, or even a promise to refrain from doing something. Mutual consent, also known as meeting of the minds. This means that both parties to the contract must understand and agree to the terms of the agreement. Capacity to contract is the fourth required element. Writing is not mandatory for some contracts to be valid. Question 931. A listing agreement authorizes a broker to A. Accept offers at his own discretion on the owner's behalf. B. Convey title to the property. C. Find a buyer who is ready, willing and able to buy the property on the owner's terms. D. None of the above. Correct answer is C. Find a buyer who is ready, willing and able to buy the property on the owner's terms. A listing agreement is a contract between a property owner, the seller, and a real estate broker. The primary purpose of this agreement is to authorize the broker to find a buyer who is ready, willing, and able to purchase the property on the seller's terms. This includes finding a buyer who meets the seller's price, financing, and other conditions of sale. Brokers generally do not have the authority to accept offers on behalf of the owner. They can present offers to the seller for consideration, but the seller ultimately decides whether or not to accept them. Brokers also do not have the authority to convey title to property. Only the property owner can legally transfer ownership. In essence, the listing agreement empowers the broker to act as the seller's agent in the process of finding a qualified buyer for the property. Question 932. To obtain an FHA loan, a borrower must pay a fee to a lender called an A. Origination fee. B. Registration fee. C. Loan allotment fee. D. Shipping and handling fee. Correct answer is A. Origination fee. To secure an FHA loan, borrowers are required to pay several fees, all contributing to the total closing costs. Among these, the origination fee is a common charge. This fee is specifically levied by the lender to cover the administrative expenses associated with processing and underwriting the loan. The question specifically asks about a fee paid to a lender. Origination fee is a standard fee charged by lenders to cover their administrative costs of processing, underwriting, and funding the loan. FHA loans, like other loan types, can include an origination fee. Registration fee is not a common or standard term for a fee paid to a lender for an FHA loan. Loan allotment fee is not a recognized or standard term for a fee paid for a mortgage loan. Shipping and handling fee is typically associated with physical goods, not loan processing. Therefore, the most appropriate answer is the origination fee, as it's a direct charge from the lender for providing the loan. Question 933. Which of the following has the least impact on a financial institution's deciding whether to make a real estate mortgage loan? A. Applicant's credit history. B. Applicant's income. C. Value of the property. D. Applicant's need for the loan. Correct answer is D. Applicant's need for the loan. A financial institution's main concern when issuing a real estate mortgage loan is risk assessment. They primarily evaluate the borrower's likelihood of repaying the loan. They also assess the property's value, as it serves as collateral if the borrower defaults. Applicant's credit history is a major factor. It indicates the applicant's past behavior in managing debt and their willingness to repay obligations. A strong credit history suggests a lower risk. Applicant's income is a major factor. Lenders use income and debt-to-income ratios to determine if the applicant has the financial capacity to make the monthly mortgage payments. Value of the property is also a major factor. The property serves as collateral for the loan. The lender needs to ensure that the property's value is sufficient to cover the loan amount in case of foreclosure. Applicant's need for the loan has the least impact. Lenders are not concerned with why an applicant needs the loan. Their decision is based purely on the applicant's creditworthiness, repayment capacity, and the collateral's value. The need is subjective to the borrower, not an objective lending criterion. Therefore, the applicant's need for the loan has the least impact on a financial institution's decision. Question 934. On June 1st, Saul calls David and offers to buy his used Honda Civic for $15,000. Saul promises to keep the offer open for 2 weeks and, in return, David promises to pay Saul a dime to keep the offer open. On June 6th, Saul calls David and tells him that he is withdrawing the offer because he no longer wants to buy the Civic. On June 8th, David calls Saul and accepts Saul's offer to buy the Civic for $15,000. Saul refuses to buy the car. David sues Saul for breach of contract, arguing that his acceptance of the terms of Saul's offer created a binding agreement between them. David will probably A. Win, because the offer was still valid when David accepted it. B. Lose, because David did not accept the offer until after Saul had withdrawn it. C. Lose, because $15,000 does not match Car Buying Guide's assessment of the Civic's value. D. Win, because Saul's withdrawal of his offer needed to be in writing to be effective. Correct answer is A. Win, because the offer was still valid when David accepted it. This scenario hinges on the concept of an option contract. Saul offers to buy David's Civic for $15,000. Crucially, Saul promises to keep the offer open for 2 weeks, and in return, David promises to pay Saul a dime to keep the offer open. This promise of consideration, the dime, for the promise to keep the offer open creates a valid option contract. Once an option contract is formed with valid consideration, the underlying offer becomes irrevocable for the specified period. The offerer, Saul, cannot withdraw it. When Saul calls David on June 6 to withdraw the offer, this withdrawal is ineffective because the offer was made irrevocable by the option contract. When David calls Saul on June 8 and accepts the offer was still legally open and binding due to the option contract. Therefore, David's acceptance formed a valid and enforceable contract. David will probably win because the offer was still valid, irrevocable, when David accepted it. Question 935. A land contract can be viewed as an alternative for a trust deed or promissory note because a land contract is A security instrument, B. Option agreement, C. Bilateral contract, D. Mortgage. Correct answer is A security instrument. An option gives a right to purchase, not an obligation to pay over time. While a land contract is a bilateral contract, this describes its contractual nature, not its function as a financing alternative. Trust deeds and promissory notes are also part of bilateral agreements. While a land contract serves a similar purpose to a mortgage, it is distinct in its structure. In a mortgage, the buyer receives legal title immediately and grants a lien to the lender. In a land contract, the seller retains legal title until the contract is fulfilled. A land contract, also known as a contract for deed or installment land contract, is an alternative to a trust deed or promissory note because it acts as a security instrument. In a land contract, the seller retains legal title to the property until the buyer completes all the agreed-upon payments. This retention of title serves as the seller's security interest, ensuring the buyer fulfills their financial obligations. It effectively secures the buyer's promise to pay, much like a trust deed or mortgage secures a traditional loan. This arrangement can be beneficial for buyers who may not qualify for traditional financing, but it also carries risks for both parties.